Why do regional banks fail? That's a $1 trillion question. In the 21st century, we start out with very few bank failures, but the 2008 financial crisis, we saw a spike of bank bankruptcy. The biggest bankruptcy in U.S. history, Washington Mutual Bank, at the time had 432 billion in market value. And at the same year, we also had 24 other bank failures with a combined value of $94 billion. And after that, with the crisis runs through its course, we still had bank failure in the next few years, but they are in a smaller size. Fast forward to 2023, we had three major bank failures in within 2 months, which is the Signature Bank, 110 billion, Silicon Valley Bank, 209 billion, and First Republic Bank, 230 billion. So even we only have three this year, but their combined market size already exceeded what we had in the 2008 financial crisis. That's the magnitude. Think about that. So what is a bank? What does a bank do? This is their business model in a nutshell. And they take in deposit and then lend it out with a higher interest rate. And then they make money, so-called in net interest income, which is the higher interest they earn minus the lower interest they had to pay. That's what they make money off. And look at the source of fund in a little bit deeper, we'll see they don't have to pay interest for all the money. People with checking account normally don't get any interest because for the convenience, writing a check, getting bank service, they're not paying those people. So they get some money in free of charge. And then the other is the time deposit, saving account, certificate of deposit ranging from maybe 3 months all the way to 5 years. They had to pay some interest off. So how they use those funds? They can make business loan for company with working capital need, 1 year up to 3 years. They will lend you money when you buy the car, auto loan, 5 to 7 years. They make interest of that. They also, the big one is the mortgage loan when you buy a new home or a second-hand, a used house. Normally is 15 years, 30-year fixed interest loan, but it could be as low as 5 years as well. That's probably the biggest portion. And then credit card debt. Very high interest rate now is probably 25% or more, but the bank don't have any collateral, not a house, not a car, not a business, so they don't have any collateral. All they have is depend on your credit history, your FICO score. So high interest rate, but they also have some bad debt as well. So as you can see, the biggest job for the bank to do is to manage their asset liability. You can see their liability measured by taking money in from customer, short term. Uh, Checking account, you can withdraw all of them anytime you want. And saving account or certificate of deposit might be a penalty if you withdraw uh, early, premature. But the assets are very long term in nature, 5 year all the way to 30 year. So you see the asset, the value could vary based on the time of whatever asset they own, and the liquidity, which is the biggest one. If they had to sell it and there's nobody there to buy it, they had to take a loss. And then if when they lend money out, the interest spread between their deposit rate is not high enough, and then they probably won't make enough money, won't break even. And the biggest rate is the duration gap. That when money customer coming to ask for money, but the bank didn't have enough cash on hand, some of them already committed in loan for 30 years. So why did Silicon Valley Bank fell in an example. So after 3 jobs they do, they did very well in one and miserable in two. What they did well is attracting deposit. Normally, regional bank had trouble with that, but they did a great job taking deposit from tech startup and venture capital. And the total client fund at the end of last year was 375 billion, 14% year-over-year increase. So really good job. And the last one, they didn't do very well. They only, out of the $375 billion they took in, they only managed to lend it out as loan for less than 19% of them. What about the rest of the money? Because a lot of them, they still had to pay interest. So they put it in low interest treasury bond. And then to enhance the treasury, they want a little bit higher return. They go down to get the mortgage-backed security, particularly U.S. agency bond like Freddie Mae and those kind of is a little bit less liquid, but pay a little bit higher interest. And then the job in between, the ARM risk management, they did really bad. They didn't hire people that know risk management to be the executive managing the risk management department, and they didn't hedge the interest rate. When the U.S. interest rate was 0%, the only way to go is up, but they didn't hedge that. And we know the interest rate, the yield, and the bond value is negatively correlated. When Fed raise rate, interest rate go up, the bond value go down, which means that the holding they had drop in value. And you can see that the red line is the 10-year U.S. Treasury, CBOT 10-year Treasury bond future. So it started out before the rate hike last March. It was the value is 126, and then it dropped as low as below 110. So even in here, it dropped about 15%. And this is the highest quality U.S. government bond, the most liquid bond, that still dropped in 15%. So when you talk about the illiquid agency bond, that could drop 20, 30%. And then at the same time, you see the Silicon Valley Bank stock, the stock dropped in value, kind of like in line with it, correlated very closely until it stopped here. So what's the bank run? How they happen? So first is customer withdraw money from their deposit, and then the news get out and a lot of people doing the same thing. And then what happened? That bank don't have enough cash in the bank, so they had to sell assets to raise money to fulfill their obligation. So after they sell the kind of like money market, close to money cash asset, they had to sell the illiquid longer term asset, which is the bond that Silicon Valley hold. So the bond already declined in value to begin with. And if they had to sell it really fast, fire sale, they had to take a bigger loss. For example, if you put $1 million in Silicon Valley and you want it back today, they don't have $1 million because they already put your $1 million into bond. And then the bond in a year is only $800,000 left. So if they sell it really fast, they want to get the money today, probably they can only get $700,000 back, but they still owe you $1 million. So that cost is the not just from the interest rate spread, is the value of their liability is still the same 100%. You put in $1 million and then they still own $1 million, but they invest $1 million in bond, it only worth $800,000. So they're insolvent because of that. They don't have enough asset to cover the debt. That's when FDIC took over. So is it the end of bank failure? I don't think so. If you look across the board for all the regional bank and smaller bank as well, you see that they did poorly on all three areas. smaller bank had difficulty attracting deposit. In wake of bank crisis, a customer take money out of a regional bank and put it in JP Morgan and Bank of America Ally. And then also investor find out that money market can deposit can make 4.5% in interest. But the big bank only pay them sometime at 0.01% interest. So they take money out of bank saving bank deposit and move away to money market fund as well. So the third one in investment, right? As interest rate rise, the bank tighten their credit standard and make fewer loan. The other thing is since the interest rate is so high and that reduce credit need from household and business, that together shrink the income for the bank as well. And then this one, they still do very bad. For the asset that to be held to maturity for a long term, accounting rule allow them to put it in book value. But they buy it at $1 million, they say I'm going to hold it for 10 years, and they don't need to record the fluctuation in actual market value. So because at the end of the year, Uncle Sam will always give them the $1 million back if they put it in U.S. Treasury. But when the bank starts selling assets, they had to sell some of those assets before they mature. So all in a sudden, you find out those assets no longer worth $1 million, and that could cause a huge loss when that is disclosed. So when that happens, it triggers bank run. People take out money from the bank, and if it's a public company, their stock price crash as well. So that's my first episode. I called it 10 slides under 10 minutes. I would discuss one subject at a time, try to use 10 slides or less and 10 minutes or less. You can follow me on TradingView, tradingview.com. My username is Jim Huang Chicago. And you can also follow me on YouTube like this video, and you don't need to memorize the entire stream. In YouTube, there's a shortcut. When you go to youtube.com, add Wall Street Farmer. That's my channel. And last Thursday, I was interviewed by TradingView show, live stream for 1.5 hours. Episode 7, Banking Crisis Deep Dive with me. And now you can also find that video on YouTube. And go to the YouTube at TradingView channel. You can find me there. Thank you very much.